Hello everyone, my name is Karl Sjogren. I am going to present the Fair Share model to you at this FinTech Career Virtual Summit. The Fair Share model is a performance-based capital structure for companies that raise venture capital via a public offering. It's the subject of a book I'm writing and crowdfunding for. Since this is the FinTech Virtual Summit, let's talk about FinTech and capital structures. FinTech is generally thought to be innovations that make transactions work better for more people. The Fair Share model inhabits a corner of that neighborhood. Capital structures get less attention than Bitcoin and mobile apps, but that shouldn't be the case. A capital structure is to a corporation what DNA is to life. It defines the relationship among investors and between investors and employees. It informs capitalism itself, how capital and labor relate to one another. The Fair Share model is an innovation in capital structures, the kind used by venture stage companies when they raise capital in an IPO. It adapts features from a private offering, one which only is open to wealthy investors, to a public offering, one in which anyone can invest. The positioning of the Fair Share model will be clear as you look at the kind of capital that companies raise, debt or equity, how it's raised, a private offering, which is again only open to accredited investors, or a public offering, which is open to anyone. The stage of development, is it an established company or a venture stage? And then the deal structure itself. How does the value of future performance relate to the valuation? Is it baked in or is it excluded? The Fair Share model ties together an equity offering, a public offering, venture stage company where the future performance is not in the offering valuation. Some new SEC rules on public offerings are relevant. One is the new Reg A Plus offerings, which went into effect in July of last year. A Reg A offering is a scaled down public offering. Anyone can invest and the stock is tradable. There are two types, a Tier 1 offering where a company can raise up to $20 million per year, or a Tier 2 offering where it can raise up to $50 million per year. For a Tier 1 offering, a financial statement audit is not required, but a review by an independent accounting firm is. An offering is reviewed, a Tier 1 offering is reviewed by the SEC and state regulators, some of which have a merit review standard, which is basically applying any state that has a merit review standard can evaluate whether they think the terms of the offering are fair or not to its residents. A Tier 2 offering, a financial statement audit is required, and the offering is reviewed only by the SEC, not the state. So if you have an audit, you can simplify the review process so that it's a disclosure review by the SEC only and not be subject to state review. The second rule has gotten a lot of attention, equity crowdfunding rule. It goes into effect this month, May 2016. It allows companies to raise up to $1 million per year. An audit is not required for the first-time user. Anyone may invest, but there are limits based on investor income. The stock is not tradable for a year, and there's a new way to sell stock, investment portals. Fair Share Incorporated was a crowdfunding pioneer. Fair Share was a company that I co-founded and ran from 1997 to 2001, about 18 years ago. Our big idea was to organize investors to get better deals on IPOs, direct public offerings in particular. The plan was to build an online community of investors interested in venture stage companies, provide them education on deal structure and valuation. Companies with a public offering would get commission-free access to pitch their deal to our members if they had a legal offering, passed our due diligence, adopted the fair share model, and allowed members to invest as little as $100. Our positioning was unique in that we were not a regulated broker-dealer, but we weren't going to handle anyone's money or stock. We were simply building community. What happened? Well, you know what they say about pioneers and arrows. The fair share model was too early. We underestimated the time and expense of dealing with the concerns of securities regulators. The dot-com and telecom bust undermined investor interest in venture stage IPOs, and frankly, the 9/11 terrorist attacks buried it. We did have an accomplishment of 16,000 opt-in members. About 2/3 were free members, 1/3 decided to join as a paid member, in essence demonstrating a form of rewards-based crowdfunding. They liked the idea that we were working on and wanted to support it. In 2013, I resurrected the idea. Now, let's review what happened before that. The Great Recession began in 2017. There's great dissatisfaction with convention, rising interest in entrepreneurship. The Jobs Act of 2012 creates reforms in the securities law that ease restrictions on capital formation. There's widespread excitement about making it easier for young companies to sell stock. But no one was talking about deal structures. So my conclusion in 2013 was the time was right for the deal structure that Fair Share promoted. Other parties would emerge to help issuers market their offering. And a book about the Fair Share model would spark discussion about how to reimagine capitalism. Here we are in 2016, and I'm crowdfunding to publish the Fair Share model. My draft is about 90% complete. I have a publisher selected, Inkshares, who uses rewards-based crowdfunding to decide what projects to back. It will commit the resources to edit and publish the Fair Share model after it receives 750 pre-orders. You can preview Chapter 1 at inkshares.com, and there's a direct link. The Fair Share model is a crowd-vetted book. By that I mean I am sharing my draft material on my website, fairsharemodel.com. The first section is comprised of 7 chapters. It introduces the Fair Share model, provides orientation for readers who may be new to the subject of capital structures. The second section is really the macro context for the Fair Share model: economic growth, income inequality, ideas about cooperation, and really more about economics and philosophy. The third section is about valuation. There's chapters about concepts, calculation, evaluation of valuation, and disclosure. And then there's a chapter that looks at ways that investors lose money on venture stage companies. Chapters to be addressed yet, written, are going to go look at secondary markets, accounting issues, game theory, behavioral finance, and some wrap-up matters. A webinar bonus here is a special version of Chapter 13. It has tables to look up pre-money valuation based on the percentage of the company sold. The Fair Share model begins here with this dialogue. An entrepreneur says, I have an idea, but I need money. And the investor asks, how much of your company do I get if I give you the money? And here is the Fair Share model. There's 2 classes of stock: investor stock, which is in essence common stock, and performance stock, which is in essence preferred stock. Both vote, but only the investor stock can trade. The performance stock can never trade. It can, however, based on milestones, convert into investor stock. For the types of items that normally would require shareholder approval, board member election, changes to the conversion criteria, any compensation plans involving investor stock like stock options or restricted stock grants, changes to the capital structure, an acquisition, all of those require the approval of each class. My vision and goals and perspective for the fair share model. Well, keep in mind the fair share model is an idea. It's not been used before. But my vision is that middle class investors can invest in the IPOs of venture stage companies on terms comparable to those that venture capitalists get in a private offering. My goals, an alternative for a VC round for companies, liquidity for pre-IPO investors, and an attractive option for public investors. The perspective that I take is that of the average investor. My ranking of interest is in first place, IPO investors. What's best for them is the most important criteria. The second place is a tie between the entrepreneurial team and the pre-IPO investors. Third place in my hierarchy of importance is the secondary market investor. There's a hierarchy here because you can't make everybody happy, solve a problem for everybody in the same way. But if you look at IPOs themselves from this perspective, where the IPO investor is the most important, you'll have an intuitive sense for the fair share model. Well, what is a venture stage company? It's a company with these risk factors. The market for its products and services is uncertain. It's an unproven business model, uncertain timeline to profitable operations, negative cash flow from operations, which means it requires investor cash to operate, little or no sustainable competitive advantage, and has high execution risk. The team may not build value for investors. These types of deals are everywhere. Many public companies that have gone public over the last 30 years list such risk factors in their prospectus. The Jobs Act reforms will increase the number of public venture stage public companies, but they are not new. The fair share model premise is that ideas are just a multiplier of execution. And see, you have two tables here, the value of an idea, where an awful idea has a value of -1 and a brilliant idea is 20. And then there's the value of execution. No execution is worth $1. Brilliant execution is worth $10 million. To make a business, you need to multiply the two. The most brilliant idea with no execution is worth $20. The most brilliant idea takes great execution to be worth $20 million. But that premise doesn't explain the valuation of venture stage companies. If you look at the image here, you can see how the valuation climbs to the point of the initial public offering. So the question I want you to ask yourself is, what drives the increase in valuation that often occurs as a company approaches its IPO? Is it performance, or is it something else? I have two explanations. One is the next guy theory of valuation, and the second one is market forces. Let's take them in turn. The next guy theory of pricing is that for an investment, price that a buyer will pay is what he or she believes the next guy will pay, less a discount. The implication of the next guy theory is that the valuation of an investment is a function of who the investor is, especially relative to the next investor. In other words, valuation is not so much a function of what the company's performance actually is. The second idea is market forces. The next guy theory applies to items without utility, like investments, securities, art, real estate. For items with utility, food, clothing, cars, a wholesale retail price discrepancy is common. Let's apply this concept to the IPO market, where the product is equity in a venture stage company, the manufacturer is the issuer, wholesale customers are the pre-IPO investors, and retail customers are public investors. Is there a comparable product with a retail market? Does that explain why the valuation goes up? No. The product between the wholesale market and the retail market is not comparable. There are important differences. The product sold at wholesale to pre-IPO investors is better than the retail version. The stocks, for example, the stock that venture capitalists get have price protection and other features, price ratchets, liquidity preferences, and the like, that give them price protection. The products sold to public investors lack such features. So, the retail buyer gets an inferior product and pays more for it. Can you think of another market, a competitive one, where that happens? What explains the price increase in the product as it approaches an IPO? The next guy theory provides insight into the dynamics, but what are the drivers? 4 hypothetical drivers. 1, it is considered normal. But many things once considered normal are no longer. It could be a bigger neighborhood. More potential buyers equals higher potential demand equals higher potential price. It could also be that competitive market forces are weak. If they were strong, issuers would compete for investors by offering lower valuations. Another possibility is the venture capital or VC value add, the knowledge, connections, and ability to write a big check quickly. The challenge for public venture capital is how to replicate the VC value add. Of course, another question is, just how much is the VC value add worth to public investors? Whatever the explanation, what risk does the IPO valuation present? You can see on the timeline here that the valuation of the company has been going up to the IPO price, and then it can be a good deal, it could be flat, and it could be a bad deal. The question is, why so much downside exposure for public investors? The valuation downside risk is due to a conventional capital structure. The famous economist, John Kenneth Galbraith, coined the term conventional wisdom. He used it to describe a convenient and comfortable point of view that is often false. There is a conventional wisdom about how to organize and value the ownership interest in a corporation, and it's reflected in a conventional capital structure. The defining characteristic of a conventional capital structure is that a value for future performance must be set when a company raises equity capital. And it's hard to do this in a reliable manner. Nevertheless, a conventional capital structure requires, indeed it demands, a value for future performance at the time of an equity raise. So the little shop of horrors that is a conventional capital structure is feed me a valuation, Seymour. A conventional capital structure's problems for public investors is that the basis for a valuation is shaky, and they assume most of the risk that it is too high. They're interlaced foundations of the problem for public investors. One, public investors pay retail, but they don't know it. They don't get a better deal because issuers see little advantage in offering one. Investors may respond to an offering that has competitive valuation with a question about what's valuation? Is that the same thing as worth? Which of course it isn't. Public investors don't demand a better deal because they are not valuation savvy. Terms were not an issue for the Occupy Wall Street protest of a few years ago. And because they're not valuation savvy, in large part, because the Securities and Exchange Commission doesn't require issuers to disclose valuation in their offering document. They have to calculate it themselves. The fair share model is unconventional. Its complexity favors public investors as well as well-performing teams. By the way, that's another difference. Where there is complexity in a conventional capital structure, it usually benefits wealthy investors, not average ones. The fair share model is unconventional because there is no need to place a value on future performance. Remarkably, it provides incentive to offer IPO investors a low valuation. Entrepreneurs do not care what the pre-money valuation is, for it doesn't affect their financial position or voting power. What matters to them is what does it take for my performance stock to convert into investor stock. The incentive might include a rise in the market cap. If that's defined as performance, it could trigger conversions. So here we see an image of the conventional model, and here's a company over a 10-year period, and you can see it has an initial public offering in year 6. So prior to that time, only accredited investors may invest. After the IPO, any investor can invest, and the line shows the valuation curve. So you can see how it climbs up to the IPO, and then after the IPO, you see a possible post-IPO valuation range. It can be going up or it can drop. In the fair share model, the same company, the company would go public earlier. It would raise some of that venture capital maybe in year 2. So that means any investor could invest earlier and at a lower valuation. The downside, the key point is that there's low risk of overpayment for IPO investors, and the post-IPO valuation rise, should it happen, is shared with the performance stockholders, the employees. The Tao of the fair share model is a lot of fun. Taoism is a Chinese philosophy about truth. Finding one's Tao requires meditative and moral exploration. The fair share model Tao is the harmony of interest within the uncertainty of a venture stage investment. Contemplate this question. Should the ownership interest of insiders be set before or after performance is delivered? Put another way, should the uncertainty of future performance be borne by insiders or by new investors? Those who believe the risk of future performance should be borne by new investors will favor a conventional capital structure. Those who believe it should be borne by insiders will favor the fair share model. Let's visualize the Tao of a fair share model. The principle is, in a venture stage company, Uncertainty can be moved but not eliminated. Imagine a long balloon, but instead of air, it is full of uncertainty. The kind of balloon that you can make into animal shapes. One end of the balloon represents ownership interest, while the other represents future performance. And also we'll visualize certainty as a weight. Now, let's look at where the uncertainty is. In a conventional capital structure, ownership interests are set when there is a financing. So the weight of certainty goes on the ownership side of the balloon. That pushes the uncertainty into performance. Will it be delivered? How valuable will it be? With the fair share model, it's the opposite. The weight of certainty is on performance. It's been delivered, and its value is more or less apparent. The uncertainty moves to ownership. How much performance stock will convert? In a conventional capital structure, the bet is on valuation. In the fair share model, the bet is on human behavior. Will the shareholder classes agree on how to reward performance? It's a different bet, not necessarily a better one. Interestingly, let's look at how VCs deal with uncertainty. You can see here the weight of ownership and the weight of certainty is suspended above the balloon. So all that uncertainty is just distributed both on ownership and performance. In other words, VCs suspend the weight of ownership certainty until there is performance certainty. Their deal terms enable them to retroactively increase ownership interest if a company falters, or to expand ownership when it looks like a winner. The takeaway is that the fair share model simulates a VC deal structure in a public offering. So what constitutes performance? A company's insiders and investors decide. There is no one-size-fits-all answer to this question. It will vary based on a company's industry, stage of development, geography, and even the personalities involved. Possible components could be the market price of investor stock, the financial performance of the company, sales and profits. It could be operational achievements, such as release of a product, market share, if it's a biotech company passing FDA testing. It could also be the value of the company when it's acquired, sometime after the IPO. Or interestingly, measures of social good. There's more interest in impact investing nowadays. So, entrepreneurs, pick your challenge. In a conventional capital structure, the challenge is, what is the value of my future performance now? With the fair share model, it's how do I define my deliverables? While that's being decided, VCs are getting enough success with their venture stage IPOs that public investors may eventually say, I'll have what they're having. Then, interest in the fair share model will grow. Capital market forces are weak. That's the most controversial assertion in the fair share model. That venture valuations reflect weak market forces, an inefficient market driven by public investors, next guys, who are unsure what valuation is, why it is important, how to calculate it, which you'll learn how to do with the bonus material, let alone evaluate it. Skeptical about this idea? Ask yourself, why don't companies compete for IPO investors by offering better deal terms? One chapter, chapter 15 in the valuation series, argues that the SEC could strengthen market forces if it requires issuers to disclose their valuation in their offering document. This would be like investors wouldn't have to calculate it. They could see what the figure is. This would promote make it easier for third-party data aggregators to do what happens in real estate, where for a given home, you can see what comparables are in a neighborhood. You could also see the valuation trend for that particular piece of real estate. I hope you join me in calling for it, because this would actually be a good thing for capital markets. Now let's look at how the fair share model might play out in some scenarios. What kinds of companies might adopt the model? I've got a few names that I've given to types. One is a feeder. It's a company that seeks capital in an IPO to develop a product, but plans to be acquired at some point. An aspirant is a company that raises money but aspires to build a company for the long term, not to be acquired. There's a pop-up, a company that wants to fund a project of some type. A spin-out, there may be tired backers, a venture capitalist living dead, some to-be spun-out division of a company. A rejuvenator, an established company that is in financial distress. Imagine General Motors in 2009. These categories can overlap, plus the company can be a shape shifter. They can move from one category to another. Here are the target companies for a fair share model. I want to focus on two that are strategic for the fair share model: a feeder and an aspirant. They're strategic because I think they will be the early adopters of the fair share model. So, prelude to some charts here, I'm going to show 5 charts that illustrate possible scenarios for feeders and aspirants. What the charts all have in common is they will show the conversion of performance stock and how it dilutes the investor stock. So keep in mind that we're going to be looking at the composition of 100% of the investor stock at different points in time. And that's comprised of the investor stock at the IPO, which was sold to new investors and the pre-IPO investors had as well, plus the performance stock that converts. So next we're going to look at 2 charts that illustrate performance stock conversions for a feeder. One will be if the company is acquired 3 years after the IPO, and there's something called presumed performance. And then there's another chart where the company is acquired 1 year, also as presumed performance. So here's the chart. Feeder acquired 3 years after IPO. Now if you look at the vertical chart axis, you can see it's the percentage of investor stock, and it goes from 0 at the bottom to 100%. And as you move over in time, you can see that there's some blue that's going in there. What that shows is the proportion of the investor stock that is resulting from performance stock conversions. So if you look now below the table, you can see from money, 100% of the investor stock is from money at the IPO. And in this particular case, you can see how it drops over time. So there is a presumed performance assumption here of 8% of a year up to 20% maximum. Presumed performance is a employee goodwill incentive. It's sort of like stock options that vest based on time versus on performance. There's no need to define or measure quarterly performance for a period. The company may be in a developmental stage and it's just a hassle to try to define performance. But you want to give employees an incentive to continue to do work. So in this case, there is an acquisition in year 3. And the value is considerably higher than it was at the IPO. Now, the two groups have to agree on how to split the proceeds. And in this case, the investor and performance stockholders agree to split the price evenly. So 50% of the investor stock in year 3 is from performance stock conversions. And if there's no agreement, there's no acquisition. Now here's the same type of scenario. The only difference is that the acquisition happens 1 year after the IPO. So there's presumed performance just as before, 8% a year or 2% a quarter. Acquisition offer 1 year. The shareholders agree in this case that 60%, not 50%, 60% of the proceeds should go to the performance stockholders. It's 10% higher because the offer came faster, 1 year versus 3 years. Now we'll look at three charts that illustrate scenarios for performance stock conversion for an aspirant. This is the kind of company that wants to build value in the long term. One version is going to be no performance at all. Another chart will be presumed performance, but really no actual performance after that. And then there'll be presumed performance with actual performance that's pretty good. So here's an aspirant building for the long term. There's no presumed performance rule. It's all based on actually meeting the deadlines or performance milestones. So imagine it's a biotech company and its product fails FDA testing. Or a game developer that doesn't release a product. Or a software developer whose product flops. Since there's neither presumed performance or actual performance, there are no conversions. Therefore, only investor stock issued for money or pre-IPO performance is tradable. Now here's another aspirant chart where there's only presumed performance. Same as we had for the feeder, 8% a year, 20% maximum, and the company fails to meet any of the other actual performance goals, so the conversions cap at 20%. Most of the liquidity is held by the investor. And finally, we'll have an aspirant with presumed and actual performance. Same presumed performance assumption as before, 8% a year up to a maximum of 20, and then the performance is strong, which leads to conversions that exceed the presumed performance. Now, I'm not going to go through all the details of the numbers here because it's all hypothetical. The point is that this is a team that performs so well that it winds up with 76% of the investor stock after 7 years, which is far more than would be possible with a VC round. So that's the incentive for the fair share model, or the appeal of the fair share model for a well-performing entrepreneurial team. They could end up with more of the equity than they would with a normal VC deal. The fair share model bargain for investors. If the company performs, investors will be diluted on a percentage basis, maybe by a lot. However, if the performance translates into a higher valuation, investors should not suffer economic dilution. Their stake should grow in value. VCs like to say, I'd rather own a small slice of a big pie than a large slice of a small pie. It's the same principle. The bargain for employees is that in addition to other compensation, salary, benefits, bonuses, stock options on its investor stock, employees have an interest in its performance stock pool. It's like cheap founder stock. Its only value is its ability to vote and potential to convert into investor stock. As the team performs well enough to meet the conversion criteria, employees have another way to earn stock that they can sell or hold. This is huge potential. For a company that adopts the fair share model could have a competitive advantage with respect to attracting and managing human capital. Because it could say, there's founder stock, and it only has value if we as a team are delivering the results that create conversions. So an employer's brand reflects how it implements its philosophy about people. I think most people would be pleased to get an offer that includes performance stock. It's all about balanced and aligning interests, shared values. The entrepreneurs have an incentive to offer public investors a low valuation. Equity incentives are tethered to collective operational performance versus valuation at individual option grant dates, which employees don't control. Investors have an interest in helping the company meet its goals. The bottom line is the use of cooperation as a competitive tool. The fair share model has 3 challenges. The first is to show that a lot of investors like it. They have to signal interest. That will signal interest to companies that there's a market for it. So before companies think about how to make the fair share model work for them, a lot of you need to make a lot of noise. Just like the tiny residents of Whoville in Horton Hears a Who by Dr. Seuss. Each of your voices must generate buzz, sounds that lead others to take note and join in. People who like the fair share model must combine their small voices and shout, "We are here, we are here, we are here!" The second challenge is to debug and tune it. This will be done by experts in capital markets once they know there's a market for it. The ponderables will be, how might performance be defined? And again, there's going to be variation in how this is answered. Who should define performance is another ponderable. How might it be measured? Who should measure it? How should the rewards of performance be allocated among the employees? Who should administer the rewards of performance? It's a lot of ponderables. Oh, and the tax and accounting implications. But a conventional capital structure has ponderables too. Does it scale downward? Does the approach used for established companies really apply well to venture stage companies? I think not. Another ponderable, can the interests of investors and employees be better aligned as the valuation climbs? Tough challenges. The third and final challenge will be time and experience. Sustaining goodwill between the providers of capital and labor is the central challenge. So here's a sort of a concept map, adoption curve, and the concept definition is really what the book is about, and trying to see if people like it. Can it work? And then there'll be companies that try it. Some will not do well because they're venture stage companies. Some will do pretty well. And it'll be through the process of time that the model gets more robust. Eventually, in a generation or so, I expect it to be considered the new normal for how venture stage companies raise capital in a public offering. So there's a lot to think about, and I hope that you'll join me to explore the new frontier, better capitalism. For this is the construction of a fair share model. Its mission to explore new relationships between investors and employees, to help entrepreneurs raise venture capital, to boldly go where no capital structure has gone before. Help build the fair share model. Pre-order it from InkShares. Read the draft chapters. Help make it better. Send me comments, challenges, I love them, and suggestions at the email address here, Karl@fairsharemodel.com. And then create buzz about how to reimagine capitalism. Thank you for taking the time to learn about the fair share model. Bye.